All right, welcome back, everyone. Ready to dive deep again.
Always ready.
This time, we're looking at Great Eastern Shipping Company, their Q2 FY25 results, to be precise.
Ah, yes. I saw those came out.
We're working from their investor presentation, hot off the presses, and a press release announcing the results.
Should be interesting.
Oh, definitely. If you don't know, Great Eastern has been around since 1948.
Wow, really? That long?
Yep. They've got a whole coffee table book, actually, chronicling their journey from a small outfit to a shipping powerhouse.
I can imagine they've seen a lot of changes in the industry over those decades.
Definitely. Okay, so let's get right into it. The headline number, INR 576 crore consolidated net profit for Q2 FY25.
Okay, I have that right here.
Down a bit, I see. From INR 595 crore in the same quarter last year. But, and this is important, this is what's called reported profit.
Right, which is not always the full story.
Exactly. In the shipping world, there are lots of adjustments. You know, currency swings, one-time gains or losses, all that fun stuff.
Makes it hard to compare apples to apples sometimes.
Yeah, so you have to look at the normalized financials as well.
And those give a better sense of the underlying performance.
Precisely.
And what does normalized show us here?
Well, their normalized net profit is actually higher, INR 623 crore.
Oh, interesting.
They're making some adjustments for exchange rates, it looks like, and currency swaps. I won't get into all the technicalities, but it's worth noting.
Definitely. Those things can have a big impact on the bottom line.
Absolutely. But hey, you want to know what really caught my eye? The dividend.
Oh, yeah, the dividend. That's always a good sign. What is it this time?
INR 7.29 per share.
Not bad at all.
And this marks their 11th consecutive quarter with a payout, up from INR 6.3 meter per share in Q2 of the last fiscal year.
Wow, that's pretty impressive. Consistent dividends can really be a draw for investors.
Makes you wish you owned some stock, right?
Haha, maybe.
But seriously, why are dividends such a big deal? What makes them so attractive to investors?
Well, simply put, it's a company sharing its profits directly with its shareholders.
Okay, yeah.
And when a company consistently pays out dividends, especially increasing ones like we're seeing with Great Eastern, it can signal that they're financially stable and confident in their future. Investors love that.
Makes sense. Now, let's zoom out a bit, talk about the shipping industry as a whole. It's not all smooth sailing, right? Oil prices, global politics, heck, even things like canal traffic. It all plays a role.
Oh, for sure. It's a very complex industry with lots of moving parts.
And Great Eastern operates across a whole range of categories. Crude carriers, product carriers, gas carriers, dry bulk carriers, even offshore services like drilling and logistics.
Right, each with its own dynamics.
So I'm curious to see how all these different segments performed in Q2. The presentation breaks down their revenue days for each. Looks like a bit of a mixed bag.
Yeah, let's dig into that. Where do you want to start?
Well, I'm kind of intrigued by the crude tanker segment.
Okay, yeah, let's see.
Their earnings were down 30% year on year. And the presentation mentions overall seaborne crude trade declined by 3% during the quarter, largely due to weaker refinery margins.
Interesting.
And on top of that, get this, Chinese crude imports dropped by 8%.
Wow, that's significant.
So what's going on there? What's driving those numbers?
Well, that drop in Chinese imports is pretty telling. Seems like those weaker refinery margins made it less profitable for them to process crude oil, so they reduced their imports.
Makes sense.
And that, of course, has a ripple effect across the entire crude shipping market, impacting companies like Great Eastern.
Right. But how did they respond to that challenge?
Well, this is where their strategic decision-making comes in.
Oh,
They actually shifted some of their larger crude carriers, the VLCCs and Suezmaxes, to transporting refined products instead.
smart.
Yeah, that market actually saw increased demand, partly because refined products are easier to transport and store when refinery margins are tight.
So they adapted.
Exactly. They were proactive, saw the shift in the market, and adjusted their strategy.
That's great.
Yeah.
But what about their smaller product tankers? How did they fare?
So those didn't do quite as well. Earnings were down 22% quarter on quarter for those.
I wonder.
And guess what? Played a role there.
It was the larger tankers moving into that market, wasn't it?
Oh, bingo.
Yeah.
It created more competition for the smaller product tankers, basically. Put some downward pressure on their earnings.
So it's all connected.
It really is. You can't look at one segment in isolation. It's a giant global puzzle.
Totally. Now, it's not all bad news, though, right? What about the dry bulk sector? They had a good quarter, didn't they? Capesize earnings were up like 86% year on year.
Oh, yeah, they did great. That was driven by robust demand for iron ore and bauxite, especially from, you guessed it, China.
Of course.
Their bauxite imports grew something like 15% year on year during Q2, and iron ore imports remained pretty steady, so those Cape-sized vessels were in high demand.
It's amazing how much the Chinese economy impacts the global shipping market.
It really is a driving force.
Yep. So we've got crude, product tankers, dry bulk.
Hmm.
What about LPG?
Ah, yes, LPG.
I'm seeing VLGC earnings were down 53% year on year.
Yeah, that's right. Improving Panama Canal transits actually played a big role there. More ships can now pass through the canal, meaning greater availability of vessels for LPG transport, and more availability usually leads to...
Lower charter weights.
Exactly. Classic supply and demand dynamics at play.
Okay, so we've got a real mixed bag of segment performance here. Some good, some not so good. What's the overall takeaway? Are these trends generally positive or negative for Great Eastern in the long run?
That's the million-dollar question, isn't it? Remember, shipping is inherently cyclical. What we're seeing now is just a snapshot in time.
Right.
But what is encouraging is that Great Eastern has shown they can adapt. They're making strategic moves, they're responding to these shifts in the market, and that's what we'll be diving into next.
Perfect. Can't wait. All right, so we've seen how Great Eastern is handling things, navigating the ups and downs of those different shipping segments.
Right.
But let's shift gears a little now. Talk about their overall strategy. They're not just reacting to the market, right?
Oh, definitely not. They're constantly evaluating, making strategic decisions, trying to stay ahead of the curve.
And they've got quite a fleet, by the way. 41 ships, totaling over 3 million DWT. I mean, have you ever seen those massive ships in person? It's hard to grasp the scale of their operations.
It's incredible. The sheer size of those vessels is amazing.
Speaking of fleet management, they've made an interesting decision to sell 2 older vessels, a Suezmax crude tanker and an MR product tanker.
Oh, I saw that. Why would they do that, though? I mean, isn't fleet size important?
That's what I thought, but it's all about, what's it called, fleet renewal.
Right. Keeping things updated.
So shipping companies have to constantly balance owning their vessels versus chartering them,
Ah, chartering. Makes sense.
which is basically renting, right?
Yeah. Exactly. You rent the ship for a certain period. It gives companies more flexibility. They can adjust to changing market conditions, scale their operations up or down without that long-term commitment of owning a vessel.
So by selling those older ships, they're basically freeing up capital to invest in maybe newer, more fuel-efficient ones.
Potentially, yes. And it's good for the environment, too, obviously. Newer, more efficient ships.
Right. So strategic for both financial and environmental reasons. That makes sense. Okay, now the presentation also mentioned something called the order book. What exactly is an order book?
Oh, that's basically like a waiting list for new ships. Ships that have been ordered but haven't been delivered yet. And this is where it gets interesting. The current order book to fleet ratio is actually pretty low.
Low order book. Okay, why is that significant? What does that tell us?
Well, it could mean that, fewer new ships will be entering the market in the next few years.
Okay, so less supply.
Right. And less supply potentially leads to higher charter rates for existing vessels. It's a basic economic supply and demand, just with giant ships.
Huh. Right. So a low order book could actually be a good sign for companies like Great Eastern.
Potentially, yes. It's one of many factors to consider, of course, but definitely something to watch.
Okay, good to know. Now, another thing I was looking at, asset prices. For different types of ships, the presentation has a nice chart showing how those prices have been fluctuating. What should we make of that?
Asset prices are like a barometer of how the market's feeling. If prices are going up, it usually means people are optimistic about that segment of the shipping market.
Makes sense.
And if prices are falling, well, it could indicate some concerns about maybe oversupply or weakening demand.
Got it. So we can track these prices to get a sense of the market sentiment, what people are thinking about different types of ships.
Exactly. It's a good way to gauge overall market trends.
Interesting. All right, one more thing I wanted to ask about scrapping. The presentation mentions scrapping rates are currently quite low. Now, for those who don't know, scrapping is when ships are basically taken apart and sold for scrap metal, right?
Yeah, that's right. Like sending a ship to the recycling center.
Exactly.
Yeah.
So low scrapping rates, that's kind of double-edged sword, isn't it?
It is. Because on the one hand, it means those older ships are staying in the market longer.
Which could increase competition.
Exactly. And that could put some downward pressure on those charter rates we were talking about. But there's another side to it as well.
Oh.
All those older ships, eventually they have to go somewhere.
True.
And if scrapping rates stay low for a while, it could create like a pent-up demand for scrapping down the line,
Yeah?
which could lead to a tighter supply of ships later on and potentially boost those charter rates.
It's all about timing and market cycles.
Exactly.
Fascinating. Okay, but enough about the ships themselves. Let's talk about the company behind them. We've seen their profits, we've talked about their strategic moves, but what about their overall financial health? Are they on solid ground?
Oh, absolutely. This is where Great Eastern really shines. They've done an amazing job managing their finances.
Okay, I'm seeing that here in the presentation. They're talking about a net debt reduction phase. They went from having USD 360 million in net debt back in 2016 to actually having net cash of about USD 400 million in the first half of FY25.
Yep, it's quite a turnaround.
So how did they manage that?
Strong cash flow, mainly. They've been aggressively paying down debt, building up those cash reserves. It puts them in a really strong position to, weather any storms that might come their way.
Smart. And here's another impressive thing. 95% of their debt portfolio is fixed rate.
Oh, wow.
So they're not as vulnerable to interest rate hikes as some other companies might be. Plus, their effective all-in cost of debt is only about 4%.
That's incredibly low. And it makes them very attractive to investors, Low debt, stable interest rates. It shows they're being financially responsible, and it minimizes risk.
Makes sense. They're making money, they're managing their fleet strategically, and they have a rock-solid balance sheet. What's not to like?
Well, as we discussed, shipping is inherently cyclical, and it's always subject to, all sorts of external factors.
Right.
But with their track record, financial discipline, and that strategic agility we talked about, I'd say Great Eastern is well equipped to handle whatever comes their way.
Okay, good to hear. Now, before we wrap things up, I wanted to touch on their subsidiary, Great Ship India Limited. They're the ones focused on those offshore operations.
Yes. The jackup rigs.
The jackup rigs, right. I always wondered, how do those things actually work?
So they're essentially mobile platforms with these big legs that can be lowered down to the seabed, and that lifts the platform above the water. They're used for, drilling, maintenance, all sorts of operations in, well, relatively shallow waters.
Oh, so that's how they do it. Interesting. So how is Great Ship doing? What's the latest there?
The performance is improving gradually. The presentation shows an upward trend in the utilization of those jackup rigs.
So they're being used more often.
Yep, which is a good find. More utilization usually means there's more demand for their services.
Right. So the offshore market's picking up.
Seems to be, which is positive for Great Ship's future.
Okay, good to know. And lastly, I wanted to highlight Great Eastern's commitment to corporate social responsibility, CSR. They've got a whole foundation that partners with like over 50 NGOs since 2015.
Oh, wow, that's great. It's good to see companies giving back, especially those big companies.
Right, and it ties into, the whole ESG thing, environmental, social governance.
Absolutely. It's becoming more and more important for investors. Companies are being judged not just on their profits, but on their social impact, their sustainability practices. It's a big deal.
And Great Eastern's efforts are pretty impressive. They've reached something like 150,000 students with their education programs, provided health services to like tens of thousands of women and children. Plus, they're supporting women with entrepreneurship training. It's great to see.
Yeah, it's really commendable. Shows they're taking a holistic approach, thinking about more than just the bottom line.
All right, well, we've covered a lot of ground. We've gone through Great Eastern's financial performance, their strategy, their financial strength, even their commitment to social responsibility. It's been quite the deep dive. So what are some of the key takeaways here? What should our listeners remember about Great Eastern?
Well, I think the biggest thing really is to just keep in mind the cyclical nature of the shipping industry.
Right, it's not always going to be smooth sailing.
Exactly. There will always be ups and downs driven by, all those factors we talked about, global trends, commodity prices, you name it.
Like, remember that 8% drop in Chinese crude imports? Who knew that would impact Great Eastern's tanker strategy?
Yeah, exactly. It really highlights how interconnected everything is in the global shipping market. And it underscores the importance of strategic fleet management. Knowing when to own versus charter, when to sell off older vessels, how to position yourself within all those different segments.
And of course, financial strength is key.
Absolutely crucial. Great Eastern's done a fantastic job of managing their debt, building up those cash reserves. It gives them a cushion, to ride out any volatility in the market and be ready to seize opportunities as they come up.
So for anyone listening who's interested in investing, it sounds like Great Eastern is a company worth watching.
Oh, absolutely. They've got a strong track record. They're adapting to the changing dynamics of the industry, and this Q2 report really demonstrates that.
Now, before we let everyone go, I wanted to leave you with something to think about. We talked about how scrapping rates are pretty low right now, and there are a lot of those older ships still out there.
Ah, yeah. That's a good question. What's going to happen with all those ships?
Right. What impact do you think this will have on the market, say, in the next 5 to 10 years? Will
Oh,
we see a wave of scrapping,
yeah.
finally, which would tighten up the supply and potentially boost charter rates?
It's possible. Or maybe those older ships will stick around, flooding the market and pushing prices down. It's a tough one to predict, but definitely something to keep an eye on.
Lots to think about. Well, that wraps up our deep dive into Great Eastern's Q2 FY25 results. For anyone who wants to explore further, I highly recommend checking out their full investor presentation. And, if you're really interested, that coffee table book about their history sounds like a fascinating read.
It does. A great way to learn more about this industry for sure.
Thanks for joining us on this deep dive. Until next time, happy sailing.